Today's guitar is a very unusual example of the guitar making craft. It is an Ibanez Concord, which, as you can see, has a little dove on the front. It was meant as an almost exact copy of the famous Gibson Dove. As you can see, it's a beautiful piece of guitar. But what happened is that Ibanez was sued by Gibson because they made a direct copy really without doing anything else. And they had to stop making it. But this particular model became a collector's item. It's worth a great deal of money. I found it on a Facebook group at a bargain, which just goes to prove that there are bargains to be had in the world, not just in the stock market. Before we go any further, consider subscribing to the Bauman Letter, because that's exactly what I try to do, is find you bargains. All right, that's enough guitar playing for today. For those of you who may have been following my YouTube channel for a while, you'll know that I started out this year with a series called Bauman Unhinged, and it was really my take on the big ticket structural issues that affect the US economy and why ordinary investors should care. Now, recently I came across an article by one of my favorite authors on Seeking Alpha, Lynn Alden Schwartzer. And Lynn's article really, to me, summarizes, I think, some of the more, the big picture story that really combines exactly with the kind of stuff that I've been saying. Now, the reason I'm doing that today is because I think a lot of people are unaware of my kind of background picture of where I'm looking at things and why, in a sense, that makes me less of a short-term stock bull than a lot of other people. Anyway, here is basically a summary of what Lynn is saying. And again, this is something that I agree with totally and reflects a lot of my thinking. First of all, Lynn observes that empirically US tax policy has rewarded companies that use as little labor as possible to make profits. When you combine that with high healthcare costs, which are often borne by employers, and the effects of having the US dollar as the reserve currency, it makes many US companies uncompetitive globally, and as a result it has shifted the nature and the structure of the US economy towards what we see today, which is a few very, very big companies who make most of their money in software and services that do not provide many jobs. What Lynn's point is, and again, this is something that I've been saying for a long time, is that there's a limit to this, that this is based on a particular set of political choices, and if those choices change, you could actually end up with a change in the structure of the economy that can punish investors who don't think ahead and start moving in another direction. Now, my reason for doing this today, I think, is because I've said all along that I think that the political winds are pointing exactly in the direction of changing some of these things, and that's why you need to be concerned as an investor. Let's start with a chart that Lynn shows that shows the relationship between corporate taxation and US government tax receipts from corporate income. As you can see, since the 1950s, that has fallen dramatically. Next chart shows basically the payroll tax rate, which is things like Social Security, Medicare, and so on, rose steadily until the beginning of the 1990s, from where it has remained relatively stable. Now, remember that half of the payroll tax is paid by employers, right? So basically, the payroll tax is a tax on employment. It's a tax on hiring people. So you can really think of it as a type of a corporate tax, but one that is only triggered when corporations hire new employees. Now, the net result of this structural shift is that payroll taxes have increased substantially as a percentage of federal revenue, while corporate taxes and excise taxes have diminished. Now, here's a chart that shows that. You can see very clearly that the corporate tax take and excise tax takes has declined very significantly since the 1950s. Individual tax income has increased slightly, but the big one is now essentially payroll taxes. So what that means essentially is that US companies are being taxed less at the point of profit, basically taxed on what they produce and the profits they make, and taxed more on the number of employees that they have. Now, you can see this in this next chart. It shows a shift from corporate taxes to payroll taxes in terms of effective tax rates. And that is essentially what Lynn is saying is the big picture structure. Now let's turn to healthcare costs. Now remember that in addition to payroll taxes, big companies in the United States are expected to pay a big chunk of their employers' healthcare costs. We're one of the only major countries in the world where employers are expected to contribute healthcare costs for their employees. Now, in the United States, the average annual healthcare cost that's paid by an employee and employer together is around $11,000 per person, not per household, per person. While most countries, that's around $6,000. Now, you can see in this next chart that U.S. healthcare costs have risen dramatically faster than inflation since the mid-1980s. Now, the point of this is that employment paid healthcare is essentially another payroll tax, just like the payroll taxes that employers pay on behalf of their employees for Social Security, for Medicare, and so on and so forth. Now, what that means is that the proportion of taxes that companies are attracting to themselves increases as they employ more people. It decreases as they find ways to make money without employing people. Now, the third factor that Lynn points out is the role of the dollar. Now, as we know, the dollar is the reserve currency, and that means that everybody in the world wants to get their hands on dollars, which makes it overvalued. They do that because they have to settle contracts for oil and commodities and other things in US dollars. Now, the fact that the US dollar is overvalued because so many people demand it for transactional purposes outside the US means that the US is able to import more than it would otherwise, but it means that our exports are less competitive because we can't devalue our dollar to make our exports more competitive. That allows us to consume more than we produce, so we run trade deficits, but it also means that it has essentially made it very difficult for the U.S. to keep a solid employment-creating manufacturing sector. As a result, basically the supply chains that used to exist in the United States to make everything from automobiles to COVID masks, PPE, has all been sent overseas. Now, this is partly a factor that reflects what I just described as the cost of employment, the tax of employment that our current tax system does, but also healthcare costs. Now, you add to this the fact that the dollar as the reserve currency encourages the same trend in the same direction, sending jobs overseas, trying to limit the number of employment, you get in the same position. So those are three big trends pushing in the same direction. Now, one of the consequences of this is that because the employment of actual labor is discouraged by this whole setup, we've seen dramatic inequality increases in the United States. Here's a chart that shows the wealth share of the top 1% for many of our peers in different years. And as you can see, we are the highest in terms of wealth concentration. Japan is the lowest. And essentially, it has been increasing significantly over the last few years and decades. It's tapered off a little bit in 2019, but it's still trending upward. This next chart shows the relationship between mean wealth, which is essentially a figure that reflects one way of calculating the average, basically the mean wealth in the United States, the middle point wealth, with the median wealth, which is the another way of calculating it. The higher the mean to median ratio, the more unequal a country is. And as you can see, we are far and away the most unequal country in the world. Now, or at least amongst our peers. Now, as you can see, that has contributed, I think, to a lot of the conflict that we've seen, a lot of the unhappiness with Washington, D.C. It's contributed to voters seeking more radical solutions, which is, again, not necessarily a good thing for investors. So you combine those three earlier factors that I mentioned, the tax system, the effect of the dollar, the high healthcare costs, inequality also pushes us in an unstable direction. Now, another thing it does is shown by this next chart. It effectively makes the United States a country that seeks to invest more outside the U.S. than it does inside. Essentially, what this chart shows is the net international investment position of a variety of countries. The lower the figure, the more you are investing things outside of your country and into other countries, and the less you are investing in your own country. As you can see, there are a few countries that are lower than us, Spain being one, Mexico another. But in terms of the developed countries around the world, we are far and away the highest in terms of essentially directing investment outside of our own country and towards other countries. Now, the key thing is that all of these things taken together, all the things that I've described in terms of tax, healthcare costs, the effect of the dollar, our offshoring of investment, as well as equity investment and actual manufacturing investment, it means that it makes it more difficult over time for us to retain the global reserve currency status. And ultimately, a lot of this comes down to the question that when you have a system that has been working well for a long time, it tends to accumulate contradictions. Old school Marxists can tell you that the core of a good analysis often starts with looking for the ways that a successful system, a process, begins to generate trends that move against that system and eventually make it unstable. And you don't have to be a Marxist to see that this type of situation often occurs in many systems around the world. Very few systems in economics are homeostatic, where they stay like they are indefinitely. As I've said recently, the only thing that is constant is change. So effectively, Lynn's first point, and the point that I was making in my earlier YouTube videos this year, is that we are looking at that kind of a situation as well. We are looking at a situation where what has worked really over the last half century or so is in danger of falling apart. Now, let's look at some of the implications of this. The first thing that this chart shows is that, as you can see, the type of companies that have done well in the United States stock market over the last decade or so have really significantly shifted towards companies that have very low labor costs. So essentially, you can see that in that yellow line, the the companies that have the lower labor costs are actually losing weight in terms of the stock market, while those that do not are actually benefiting. Now, by contrast, what we see is that companies that, like manufacturers and retailers that have to employ people, have actually suffered. So they have turned to outsourcing. Now, that's why the U.S. has one of the lowest contributions from GDP from the industrial sector out of all major countries at 19%, whereas our contribution from the services sector is over 80%. So in other words, we've become a country that penalizes the employment of American workers, encourages capital intensity, encourages offshoring, encourages investment outside of the country and into other countries. Now, just to give you an example that I came across recently of what can happen, some Japanese automakers who have set up plants in Mexico to export into the U.S. market looked at the recent new NAFTA, the post-NAFTA agreement, the North American Trade Agreement, negotiated by the Trump administration and Mexico and Canada, and concluded that it would make more sense to increase their wage levels to their workers in Mexico by tripling them rather than bringing them to America, rather than moving their plant to America. It's that much more expensive to employ workers in America because of the tax structure and the incentive structure. So even though they're having to triple their wages in Mexico, they're still going to make more money than if they brought those jobs to America. Now, what about if you're in a labor-intensive industry like a service industry or anything like that? Well, what do? You automate where you can. You try to cut back on your health care as much as possible, which of course the law allows certain companies to avoid it altogether. You try to get government to cover your employment costs, like Walmart and Amazon employees who can't make ends meet without having food stamps and welfare and SNAP and all of that. And of course, then in the restaurant sector, the United States makes employees rely more on tips than anywhere else. Well, again, this is all a side effect of the fundamental structure that discourages employment in good, solid, long-term occupations and rather pushes people into unstable, short-term occupations. Now, the result is, as you can see from this chart, that we have a very large trade deficit. Our trade balance in goods, in other words, the physical things, we consistently import more than we export. Our balance in services is higher, but it's not enough to compensate. Now, the result of all of this, and this is why I think this is so important, this is not sustainable, folks. This cannot go on forever. We're already starting to see problems emerge. For example, this chart shows that a year of wages no longer covers the family expenses for a family of four based on the median male income in the United States. Back in 1985, you could expect to save quite a bit of money that you made if you were a median male income worker. Now you no longer can, and you can see the big driver. It's healthcare, followed closely by housing. But this also has national security implications. It's why the United States is increasingly dependent on China, an adversary country that runs a political system that is anathema to American ideals of freedom and certainly to my own. We're increasingly dependent on them for basic needs, from automobiles to PPE under COVID. And finally, this whole structure has encouraged companies to focus on developing their capital positions rather than their labor positions. And that has an effect in terms of long-term compounding. And that effectively has made the stock market more attractive over time, because companies that adopt this labor-light approach make better profits, better earnings, and they are able to attract more investment. So here's a chart that shows the long-term trend for the Shiller PE ratio up until about 1990. You can see it was around 15, now it is over 25. So even though there has been some big spikes and dips in the PE ratio, you can see that we are now balanced at a higher level. Now, the point here is that this is again quite likely a consequence of this overall structural position. Now, what are the implications for you as an investor? First of all, this is not sustainable. We cannot continue with this indefinitely because eventually the companies that are taking advantage of this are going to run out of steam. It's not going to be possible for them to continue to rely on the US dollar. We're already under tremendous budget constraints, so tax rates can't get any lower. In fact, they're likely to rise under any conceivable future administration, whether it's Democrat or Republican. Politically, we're seeing tremendous pressure to change the way we do business as a nation as a whole. And as a result, it means that the system that has allowed the United States to do what it has done and what has allowed you as investors to benefit from these big tech companies, it's not just about the technology, folks. That's the key thing. It's not just the technology that attracts the investment. It's also the structure of our political and economic, tax, currency. All these systems push investment in a particular direction that has rewarded us as investors. Now, if that fails, what happens next? Well, chances are that, like any system, we're going to run into a situation where this is going to force us to start looking for profits elsewhere, because it cannot continue. No matter who comes into office, I think in the next election, they're going to be under tremendous pressure to tweak the system to make it less attractive for American employers to offshore production and to focus on things that only produce profit and not wages. The result of that is that I predict that over the next decade or so, you're going to see much better returns in foreign markets. Now, I'm not going to make any predictions about when that's going to happen, but I think that there's going to be an accumulation of small things, little legislative changes, little pressure points that develop politically, little changes in the underlying social movements that support the different political parties are going to push them in the direction of a more populist, employment-favored approach. And that means that once those things reach a certain critical level, we will begin to see a change. And that could result in a fairly rapid shift downward in stock prices. Now, part of the problem that I've had, I think, in communicating my message is that I've allowed this big picture to overdetermine my short-term opinion to the stock market. I get it. I get that stocks have been going up because of short-term things. My point is, it cannot last, folks. And if you're thinking long-term, which a lot of people should be, like I do, like retirees, like people who are heading for retirement, you should be thinking that way too. This is Ted Bauman signing off. I'll see you again next week.